Senegal is now an oil-producing country. While it aims to make the most of its natural resources, questions still surround the exploitation contract the country signed.
Senegal has entered a new era by joining the ranks of oil-producing nations. The country extracted its first barrels of oil on June 10 from the Sangoma field located offshore near Dakar. The project, which required an investment of approximately $5 billion, aims to produce 100,000 barrels per day.
At the very least, for us, we will have access to less expensive energy than before. This will undoubtedly impact the competitiveness of businesses. We believe that with this discovery and the existing oil, we will firstly have the products available in a much more interesting way. Secondly, we hope to see a reduction in fuel costs. Additionally, it will allow the government to manage the taxation around oil so that we can have an accessible product.
Senegal possesses a significant gas reserve that could reach 100 million tons per year by 2030, with annual revenues estimated at 700 billion francs CFA over 30 years. However, there are still uncertainties around the exploitation contract, which the new authorities deem unfavorable and wish to renegotiate. In the Sangamo project, the Australian company Woodside owns 82% of the shares, while the Senegalese state owns 18%. Senegal's share of the profits ranges from 15% to 40%.
Our guest this week is Senegalese economist Ousmane Dieng. Welcome to Business Africa, sir. Senegal has joined the club of oil-producing nations. From an economic perspective, what does this mean for the country?
This is very good news for the Senegalese economy because it will be a level on which the authorities can rely to structurally transform Senegal's economy. Additionally, this financial windfall will enable double-digit growth rates and provide the means to finance the entire local economy. It is well known that for the African countries, notably Senegal, the issue of structural transformation of the economy is a major challenge. This transformation has suffered greatly from the lack of financial resources. However, we are now convinced that if this shortage of funds is not definitively resolved, it will certainly be substantially addressed. Authorities must therefore channel this financial windfall towards public policy priorities.
The Sangoma project provides that Senegal's profit share can range from 15 to 40% depending on the production. Are there risks associated with this variable profit share?
It's a contract between two entities, so the shareholders' quota naturally depends on the amount of equity investment put in place. There is thus capital based on investment plan. Within the framework of financing plan, equity financed by shareholders is the one that prevails, so perhaps Senegal could not exceed this amount. I am not saying this is a fixed situation, but if Senegal had the means to explore this oil, I believe it would have done so since 1960s. It's also important to acknowledge that there are investors who have the permits, have explored and found nothing. Therefore, all the risk today is borne by strategic financial partners. As for risks related to the variable share, they are necessarily linked to the future evolution of oil prices. So let us monitor oil prices. However, it's known that it's rare to see oil prices reach relatively low levels. Therefore, it is relatively controlled, but we must never lose sight of the fact that in a company contract, the one who invests the most reaps the most.
The new administration has pledged to review oil and gas contracts with foreign companies. In the case of Sangoma, how can the share distribution be adjusted to better favor Senegal?
Honestly, with all humility, I have great admiration for President Faye. He is a very balanced individual. However, we are in a context of political regime change. And believe me, when these investors made the strategic plan, they analyzed the macro environment and the integrated political risk. It's part of corporate strategy. But honestly, the urgency lies in determining how to quickly increase the refining production capacity of this oil locally. to significantly impact the price per kilowatt. If we manage to have abundant and competitively priced electricity, that is good. The economy demands nothing less. So for me, that is the real priority, as we can use this money to establish investment funds that will support the needs of local business. Now, there is always financial structuring to be able to collateralize future revenues, to then invest in very productive sectors. So for me, that is the real battle. Not saying instead of having 100, I want 110, because these are things that can evolve over time.